Costco doesn't make its real money selling you bulk toilet paper or oversized muffins. The entire retail world misunderstands their true profit engine. This seemingly low-margin business generates billions in free cash flow, not despite its strategy, but because of it. You're about to see how the subtle manipulation of simple cash flow mechanics transforms a warehouse club into a financial powerhouse, a blueprint for dominance hidden in plain sight. You are going to uncover the precise financial architecture that allows Costco to consistently post extraordinary returns while offering prices few can beat. We will dissect how their unique business model leverages a concept called negative working capital to generate vast sums of free cash, and why their membership fees are not just a revenue stream, but a strategic financial weapon, one that could revolutionize your own understanding of profitability. Most businesses, if you look at their balance sheet, strive for what's called positive working capital. This means their current assets, things like cash, inventory they expect to sell soon, and money owed to them by customers, outweigh their current liabilities, which are the short-term debts like money they owe to suppliers or employee wages due. It is seen as a sign of financial health, a buffer. It means you have enough liquid assets to cover your immediate obligations and then some. But Costco, in a move that seems counterintuitive to traditional finance, operates with negative working capital. What this really means is that, on paper, their current liabilities often exceed their current assets. How can a company be so incredibly successful if it appears, by conventional metrics, to be running on such a tight wire? The genius lies in understanding the speed of money. Imagine you walk into a Costco warehouse. Every item on those towering shelves represents inventory. For most retailers, this inventory sits for weeks, sometimes months, tying up capital. But Costco's inventory practically flies off the shelves. Their inventory turnover, the rate at which they sell and replace stock, is legendary. While a typical supermarket might turn its inventory over 12 to 15 times a year, Costco is often closer to 20 to 25 times annually. This means they sell almost everything they buy within a matter of weeks. Now, here's where the magic truly begins. When Costco purchases goods from its vast network of suppliers, they do not pay immediately. They typically have payment terms that allow them 30, 45, or even 60 days to settle their invoices. But they are selling those goods to you, the consumer, for immediate cash. Think about that for a moment. They receive your cash today, but they do not have to pay their supplier for another month or two. This time lag, this gap between cash coming in and cash going out, creates an enormous, continuous, interest-free loan that Costco effectively takes from its suppliers. It's like someone handed you a pile of money, told you to use it for 2 months, and then only pay back what you used, without any interest. It's an incredible financial advantage. If you are finding this deep dive into how real financial leverage works fascinating, please take a moment to like this video and subscribe to the channel. Your engagement signals to the platform that this kind of investigative financial analysis matters, helping us decode more of these hidden mechanisms that shape wealth and power. This strategy of negative working capital generates billions of dollars in what's known as free cash flow. It is cash that the business can then deploy to open new stores, invest in technology, or return to shareholders without having to borrow from banks or issue new equity. It's capital created by the very rhythm of their sales cycle. This cash flow machine gives them an unparalleled ability to negotiate even better prices with suppliers, further lowering their costs. It is a virtuous cycle, where faster sales lead to better payment terms, which frees up more cash, which allows for lower prices, which drives even faster sales. But is that the entire story? Is negative working capital alone enough to explain their exceptional margins? Or is there another, even more brilliant layer to their financial genius? The hidden lever, the true differentiator, the reason Costco can run on such razor-thin product margins and still dominate, is their membership model. This is where their cash flow engine shifts into overdrive. Every single year, tens of millions of people pay an annual fee, typically $60 or $120, just for the privilege of shopping there. For fiscal year 2023, Costco's membership fees alone generated over $4.6 billion in revenue. Think about the implications of that staggering number. That $4.6 billion comes in upfront, at the beginning of the year, from customers who may not even step foot in a store for weeks or months. This is an enormous pool of immediate, highly predictable cash. And here's the critical part. This membership revenue is almost pure profit. The cost to process a membership application, print a card, and manage the account is negligible compared to the fee itself. This pure profit stream is so significant that it essentially covers all of Costco's operating expenses, things like employee wages, electricity for the warehouses, transportation costs, and administrative overhead. Imagine owning a business where all your basic, fixed costs are paid for before you even sell a single product. That's the strategic position Costco occupies. This means that virtually every dollar you spend on a physical product at Costco, beyond the cost of goods sold, goes straight to the bottom line as profit or is reinvested into further lowering prices. They are not primarily a retailer, they are a subscription service with an attached warehouse. Consider that for a moment. This model de-risks their entire retail operation. It allows them to maintain incredibly low prices on products, sometimes barely above cost, because they do not rely on those product markups to keep the lights on. This is why their prices are so hard to beat. It also creates incredible customer loyalty. Once you have paid your $60 or $120, you feel a psychological imperative to earn back that fee by shopping frequently and maximizing your savings. This drives repeat visits and higher spending, reinforcing the entire ecosystem. Have you ever truly considered that your annual membership fee pays for the very existence of the store, allowing almost every dollar you spend on the products themselves to be either razor-thin profit or passed directly back to you in savings? This brilliant combination of negative working capital and a pure profit subscription model is what fuels Costco's seemingly unbeatable margins, allowing them to simultaneously offer value to customers, pay employees well, and generate enormous returns for shareholders. This analysis of Costco's strategy offers crucial implications for anyone building a business, investing, or simply trying to understand the economic landscape. First, for businesses, it underscores the profound power of recurring revenue and optimized cash flow. Can you build a subscription layer into your existing business, even if it is not immediately obvious? Could you renegotiate payment terms with your suppliers or customers to create a float of interest-free capital? It is not about simply cutting costs, but about engineering the flow of money through your enterprise. Consider companies that sell software as a service, or even local gyms that charge annual memberships. They are all, in various forms, leveraging the same principles of upfront, predictable revenue. Second, for investors, this reveals why looking solely at reported gross margins can be misleading. A business with seemingly thin product margins might be an absolute cash flow machine if it has powerful negative working capital dynamics or a robust high-margin recurring revenue stream like Costco's memberships. Think about airlines, which sell tickets months in advance but pay for fuel and staff later, or insurance companies, which collect premiums long before they pay out claims. These are all examples of businesses that leverage this exact principle. You need to dig deeper into the cash flow statements and the underlying business model to understand where the real value is being generated. The reported profit on a single item might be tiny, but the profit on the entire system can be immense. Third, for consumers, this understanding fundamentally reframes your perception of deals. You are not just buying cheap goods, you are participating in a highly sophisticated financial ecosystem. You are paying for access, and that access fee, the membership, is what subsidizes the low product prices and the overall operational efficiency. This isn't a critique, it's an education. It allows you to make more informed choices, understanding that your loyalty, expressed through that annual fee, is a vital component of the company's financial success. You now understand that Costco isn't just a big box store. It's a financial engine running on two incredibly powerful, interconnected forces: the leverage of negative working capital and the genius of a pure profit subscription model. You see beyond the shelves of bulk items to the cash flow mechanics that drive its dominance, recognizing how capital is truly built and protected in the modern economy. Which of these two mechanisms, negative working capital or the membership fee, do you find more impactful for Costco's success? Like this video to bookmark this precise explanation so you can quickly revisit the underlying financial genius of Costco the next time you hear someone marvel at their low prices. What you just decoded is a prime example of how the hidden financial structures, not just the visible transactions, shape the titans of modern capital. We have only just scratched the surface of how the world's most successful entities engineer their competitive advantage. Subscribe to this channel right now so you do not miss the next deep dive into the concealed mechanics of wealth and power we are already investigating.